Hey friends, it's Kristi Nowrouzi, my preferred lender. I wanted to take just a few minutes and share with you some of the more recent updates when it comes to condos and financing. So this new rule from Fannie Mae and Freddie Mac, which backs conventional mortgage loans, went into effect in March of 2026. So it's been around for a few months, but in case you haven't worked with any sellers or buyers of condos in just the last couple of months, I wanted to share this with you now so you have a basic understanding. So in the past, there's a condo questionnaire, and in the past we had a limited condo questionnaire review. What that meant is if your buyer had 25% down or more, it was a very superficial condo questionnaire. That has been removed. It no longer lives. So now, no matter what you put down for a purchase of a condo, that condo questionnaire is the full version. And so it's going to ask things like for the budget, it's going to ask how many owners are greater than 60 days late on their HOA payments. It's going to ask if the condo association is in litigation. It's going to ask for a lot more information that could fail the condo association from being approved as a Fannie Mae or Freddie Mac association. Now, there is a list that exists that the association might already be on, and then we don't have to have this, thankfully, because it can take a couple of weeks from the condo property manager or the association manager, and to the tune of $300 to $400 to your buyer to have that report done. So if it's already approved, doesn't have to be done again, but in order to get them approved, it's many pages, 6 to 8 pages long, and can take a couple of weeks. So limited review, gone. So that part stinks. What is really great though is that the actual cash value method of insurance for the Master Condo Association is now an approved level of insurance. So in the past, prior to March, we could only have replacement cost value. Let me give you an example of what all this means. Let's say that for each building inside of the association, a new roof would cost $100,000, and the roof is now 10 years old. It has an economic life of 20 years, and so the budget is allowing for that to be replaced when the time comes. But in the meantime, lightning strikes a building, and one of the buildings needs to have the roof replaced. Actual cash value would say, hey, it's 10 years old. So the value that we'll give to you is $50,000. Who has to come up with that additional $50,000 that the insurance company doesn't pay? The condo owners. And so Fannie and Freddie felt that this was a threat to the owners because you don't want to have this additional or supplemental cost each month to your regular HOA dues. So recently, in March, they removed that requirement, which is great because condo associations pay for that master policy, the exterior part of that coverage, and ACV is much cheaper than replacement cost value. So remember, replacement cost value is going to be for full coverage. If it costs $100,000 to replace, insurance is going to replace it with $100,000 to replace it. So it's treacherous because if the condo association has ACV only, if there is a shortage, it's going to have to come from the condo association or out of that budget. So, but it is nice that ACV or lower insurance costs are now allowed. Now back to not such great change. A reserve study is required for associations that are greater than 3 stories. If it's now 30 years old, and some areas like Miami-Dade are writing their own jurisdiction where it's 25 years, but generally speaking, throughout the state, if it's older than 30 years, a reserve study has to be done and greater than 3 stories, and then it doesn't have to be redone until 10 years has passed. So that part is good. Last thing I want to talk about that could really trip some things up though is a budget. So remember at the start of this I talked about the limited review. It didn't require a budget. Now a budget is required to be presented for lender loan approval of that condo association, and that budget has to show not the required 10% of years yonder, but 15% of reserves. So if we had a $3 million annual budget, in the past we had to have $300,000 in reserves set aside. Now it's going to be $450,000 because it's at 15%. The problem has been over the last couple of years, costs have gone up so much. And the condo associations have annual contracts for most things: landscaping, pool maintenance, insurance. And when they go to renew that next year's contract, the prices have gone up so much, and association managers didn't want to have to increase the HOA dues. But it comes to a point where you have to. We have to make sure that those reserves are plentiful, or they may not get condo approval, and that means you don't get a conventional loan approval. Then you're forced to have a cash buyer or a non-qualifying mortgage. Non-qualifying mortgages typically take at least 10% down, and it is a higher interest rate. Can we finance it? In most cases, yes, but at a higher cost to your buyer. So if you have any questions specific, reach out to me. I can do a lot of research on that condo association in advance of taking a listing, or maybe showing your buyer's properties there, and we can figure out some things before those initial conversations, showings, listing appointments, etc. take place. But I'd love to be a resource for you. If you have any questions, reach out to me.